Hello everyone. Today is January 5th and we're starting the new cycle of the Wyckoff Trading course, part 2, the practicum. Yesterday we've conducted the first session for the Wyckoff Trading course part 1. It lasted too long, over 3 hours, so I tried to have less material today. I want to finish on time and be done by 5:30 Pacific, so that's the goal. Okay, so for those of you who have registered, you have nothing to do but just to receive an email from us tonight with the access information to the class page. And there you will find the all of the videos that we're going to store during the duration of the course, all of the slides with the homeworks, with some of the articles that I want to post for you. So that's going to be your working page. For those of you who are new to Wyckoff Analytics just in general, and you guys are guests today, we welcome you. And as you go through this session, and at some point you're going to say, yeah, I really would like to sign up. Unfortunately, you can't sign up for this class. This is just a preview of the work that we do with more advanced traders. This is the next step beyond the Wyckoff Trading course part 1, so you will have to check that out. A lot of people come to me and they say, well, I've studied with this, teacher, I've studied with that teacher, I've taken this course, I've read this book, I'm very well versed on the terminology and so on and so forth. My reply to you is no, you're not. There is a lot of proprietary things that we've developed in the Wyckoff Trading Course 1. There is a very, very deep knowledge that we go into in course number 1. I've made this mistake many times before with those who have not attended part 1, and then they become a drag, in course number 2, in the practicum, because they don't know the semantics, they don't know the concepts, something is being missed, and I decided I will never do this again. So for those of you who are new, you kind of will have to go, through part 1, but you are very welcome to stay today and just to see what the progression you could make from part 1 to part 2. And by the way, all of the students that kind of expressed the desire to jump right away into the practicum, and then I suggested to them, start with part 1, they were extremely, extremely grateful for that suggestion. So that's kind of your path. But for those of you who are alumni of Wyckoff Trading Course Part 1, I'm definitely looking forward to work with you. So sign up. It's 15 sessions as usual. For those of you who are alumni already of the WTC practicum course, and we have quite a few students like this. Actually, some of you already taken this course for the 4th or the 5th time because it's a practice, right? So you want to habituate in the practice always. You want to have some kind of systematic approach as to how you actually observe the material and then create a skill out of that material, because again, knowledge is not the skill. So you have to have knowledge, but you also have to have a skill how to implement that knowledge. So check out our offerings. There is a payment plan, 3 recurring payments of $333. We get together each week, each Tuesday, at 3 p.m. Pacific for about 2.5 hours. Sometimes it's a little bit more, sometimes it's a little bit less, just depending, on the material, on the exercises, and sometimes, unfortunately, depending on kind of like, some of the, health issues. If I have at that moment, I will let you know. So that's the usual setup for us. So next session is going to be January 12th. As usual, homework is, in all of our WTC classes, you will do multiple homeworks. It is up to you. whether you're going to do all of it or whether you're going to do just parts, maybe one, maybe two. But there will always be homework, and we will be discussing that homework. You will also be able to send me your questions, and we'll talk about this in the second class. As I'll start receiving your questions. So the the body of questions that come from students is very crucial and important. Why? Because those are the questions that a lot of people have on their minds. They're just not asking them. So you definitely, most definitely, have to send your questions. And one requirement that I have for the questions is send your questions together with the chart. Don't ask me, a question like this. What's the difference between, let's say an upthrust and upthrust action? Send me your chart and show me how you understand this concept first. And then it will give me a better insight as to how to answer that question. And here's the first question from Iqbal. Will there be a tape reading class this spring? Not related to WTC2 course. So yes, Iqbal, why don't we talk about this a little bit later, but we will have a tape reading product for you guys. It's going to be each Mondays in the morning at 9 a.m. Pacific for an hour and a half. William, Royadon, and myself and I will be conducting those tape reading sessions. So we had quite a lot of positive feedback on that, on the interactions that we did. So yes, we will do this. I want to remind those of you who already signed up and those that will sign up for this class, all of the homeworks I'd like to receive in one file. It is quite laborious for me, to receive multiple emails where there is not a single file for the homework, but there is like 5 or 6 or 7 files. So I will have to open all of them and look through all of them. So you guys know this already from WTC1 course, so please do that. And then also, please make sure that you specify, in the file name or in the title of your email that this is the homework, and this is the homework for this class, because we receive a lot of homeworks almost each day. So therefore, it's crucial for us to be efficient. So I would appreciate this. As usual, all of our classes are extremely interactive, especially this one. So I will be calling on people, volunteering people, asking people to step in and do the exercises with me, discuss some questions, explain what they saw on the chart. This is a regular work that we do here. This is not going to change from, any semesters that we've had before. So make sure that you have a built-in microphone. That's very essential. All of the recordings and slides will be made available to our students. This particular recording we will post on YouTube tonight. So if you don't have time to go through the whole thing, and if you are, a guest, then you could catch this on our YouTube channel later on. All right. As usual, everything that we discuss in these classes is for educational purposes. Please stop your recording and read disclaimer in full. Again, for the guests, really quickly, what else is available to you? And let me rephrase this question. What else is available for free, in our ecosystem? So I would definitely recommend the weekly newsletter. Usually we have some kind of free market update each week. So this is just either my view or Bruce's view on what the market is doing, some of the ideas that we have. Regularly, that would be maybe like some tweets that we had, or maybe some videos from the classes on the market analysis. You could also know instantly, what came out this week in blogs or in the videos. And we usually have maybe about 2 to 3 videos per week that are educational videos. And then usually 1 or 2 blogs that are coming out each week as well. And those are all free, so you could find them on our website. But the easiest way is just, to have this weekly newsletter. It comes out each Sunday, and then as it comes out, definitely, just go through that. Our YouTube channel, which is called Wyckoff Trading Method, has quite a lot of videos, so go check this out, absolutely free. And then our Twitter feed usually has some videos from ongoing classes. So those are like small videos where we discuss either the current market, and there is something interesting about that, or maybe some concepts, and we would post that as well. Let's talk about the curriculum for this class. So 15 sessions, and we are building on the foundation of WTC1 course. So I build up the curriculum in such way that on Monday, we go through the knowledge. On Tuesday, we are building the skill. On Wednesdays, we're talking about the application, and together with Bruce, we're going through the markets, through the sectors, through the groups, through the stocks, through so many other instruments. And those are usually very interesting discussions with him. And then on Thursdays, we have some kind of specialty classes, developing the skill to a much, much deeper level. And sometimes on Fridays, we have, collection of, advanced traders having their own get together in the process group. So that's our weekly curriculum. But specifically for this class, what are we going to cover? So obviously, the application of the knowledge that you've received in the WTC1 course is the main agenda for this course. And with that, the main thing that we're going to do is we're going to do a lot of drills and exercises. And one might ask, well, why do you even bother? And this is the argument that I hear sometimes, from time to time, but it always comes back. It always comes to us. Everything that you do exercise-wise, including simulation trading, including paper trading, and so on and so forth, is not worth it because it's not real. So you cannot experience, the true emotions as you go through the drills and exercises. And I would say this is probably the most stupidest idea that I have heard. And if you're thinking this way, this class is not for you, because we drill and we exercise a lot here. And we prepare ourselves on the technical level and on the emotional level as well. And I'll speak about this in a second, to our actual trading. And I always compare trading to any type of sport, whatever sport you like. I personally absolutely love the NBA action, basketball. I follow NBA kind of religiously almost. I live in the Bay Area, so Golden State Warriors were just, so great to us, bringing all of these championships in 5 years, which is amazing. So here is a quick example of what we do. So Steph Curry, if you know him, he's a player on Golden State Warriors. In practice, accomplished something unbelievable. He shot 105 straight three-pointers from the corner three. Now, it is amazingly difficult to produce something like this. For 5 minutes, he was just shooting and shooting and shooting and shooting. Okay? So, and you might say this is not a game situation, and you would be correct. But all of that mechanics of how you shoot the ball so many times with the positive outcome brings you to the game more prepared. And this is what we are trying to do with trading here. And then he goes out against Portland, and he scores a career high 62 points. That's what we're doing, with this particular class. We are deepening our knowledge about the markets, about the Wyckoff method, we are practicing so that in real time we would be able to recognize the patterns, the setups, and we would act on them much better, right? With ease. If you are concerned about the mechanics when you're implementing the trade, you are not going to have a good trade because there are so many other layers above the mechanics. Your mechanics should be at the point where you just wake up at night, and if I ask you the question, where's your point of entry, you should just tell me right away. If you're not at that level, you're failing at the most fundamental level of trading, which is basically you look at the chart and you can't recognize the pattern. And if you can't recognize the pattern, and we'll talk a lot about observations and deductions today, if you can't recognize the pattern, then why are you even trading? It's just a waste of money. So drills and exercises is going to be the predominant time that we're spending in this class. All right. Another point that I want to make to those of you who are saying that there is no emotion in the exercise. Well, I've been observing our students in the last about 3 cycles when we established in this class the in detailed look at the bias game that we have. And I'll show you the bias game. We're going to go through 2 bias games today. We're going to go through those drills today, so you will see exactly what we do in the classroom. And each week, all of the students are emailing me their answers to the bias game, and I feel their emotions because we tracked how many times they're correct and how many times they are not correct. We want to understand where we stand as traders, as analysts, in recognizing, our skill level. And if you cannot, uh, you know, do the bias game correctly, majority of the time, you're not going to make money in the real market. It's just as simple. So my suggestion to our students is usually you need to overcome like this 50% mark. And it's better if you are in the 60 and a plus, and maybe even 70. Develop the skill of visual recognition to the level where you are not concerned with the mechanics of how you trade and how you analyze. Concentrate at that level on the process itself and on yourself. And then trading will be much easier. It will be less stressful. So I just don't accept that argument that exercises are not important, that they don't have the emotional component. It's just not me. And I say this openly because I want to attract students who understand this, and I want to attract students who will do drills and go through the exercises together with me in the class, because we are serious traders and we don't want to have somebody who just kind of like, I'm not going to do this. Having said this, it's up to you, obviously, to which degree you want to participate in the classroom. You could be extremely active, interacting with me, with other students, or you could be just an observer, which is totally fine. People are different, and we definitely respect that. Okay, so what are we going to concentrate on in these drills and exercises? Bias and timing is going to be the predominant concentration for us. Now that you have the knowledge, I want you to practice how do you define bias out of the consolidation. I want you to concentrate on defining the timing. When is the time to open the position, at which spots, with which kind of risk, and so on and so forth. We're going to talk a lot about trading tactics and management. So the WTC1 covers a lot of material on the basics, on the analysis itself, right? This should be a practicum, actually. And so this kind of leaves the tactics and executions and trade management to WTC2 course. So we'll talk about different scenarios and how would we deal with that. How do we prepare our minds for any type of scenarios? Because our one of our main beliefs is that the market could do anything, right? So the market is uh, has some certainty with a long-term patterns that are influenced by institutional presence, and then they are absolutely uncertain in terms of the short-term patterns where anybody could come, any hedge fund, any pension fund, any insurance company, and just dump their portfolio because they just need cash. And you might not even kind of anticipate that, but uh, we definitely want to practice creating the mind map as to what might actually happen in different ways. We'll talk about the trade management, risk management. We'll touch upon how do we filter. There's going to be quite a few exercises on selection as well. We're going to go into more depth on the Wyckoff analysis, where we'll discuss, and this cycle is going to be interesting because we're going to discuss a lot different phases, different behaviors during the consolidation, and also different behaviors for trends, uptrends and downtrends. Those are going to behave differently. They're going to have different stages, how that develops. So I'm going to bring a little bit more material on that for sure. And just a lot of other tools that we're going to go through. So this is going to be, an intellectual adventure with the concentration and focus on skill development. And if this is exactly what you want, then this is your class. Obviously, you still have to have the prerequisite. There is no way around that. So I'm just not going to allow that. But if you are an alumni of the part one, then obviously you are more than welcome. All right, let's go to the next slide. So what are we going to do today? So we're going through the introductions, and then we're going to discuss the homeworks. Right away, I'm going to give you that. Each class, I'm going to give you some kind of market update. I want you to still be in the habit of thinking almost each day about the markets, what has happened, and then quickly analyze them from the taperian point of view, from the Wyckoffian price structural point of view, from maybe some other, intermarket analysis points of view, or even though this is going to be a little bit less. So, and then, this practice will allow you not only to have the knowledge to build the skill, but also see how we could apply that in real time, week to week. Exercises. So today we're going to go through two exercises. One of them is going to be based on observations and deductions. We're going to have a little bit of a conversation there as to how do we observe, how do we deduce our observations, and so on and so forth. Then I'm going to show you some of the trades, either some of the recent trades, some failed trades, different time frame trades. So, and I'll talk about those. These are going to be different trades than we've discussed yesterday. So I'm trading very actively this year. 2020 was a really good year for trading in general, because everything is kind of like on the table. Everything is a little bit more visible. It's much faster. And whatever methodology you use, you should be able to extract the money from the markets, whether you're using momentum methodology, whether you're using trending methodology, whether you're using reversion methodology, whether you're using different time frames. Intraday traders have had an amazing year just because volatility has increased on both upside and downside. Swing traders, just, there are so many opportunities there. And long-term campaign traders, obviously, have been enjoying this, post-COVID low. And then we're going to conclude it with 2 bias games that are already out there, but we need to analyze them. We need to go through them. This is kind of like the routine that we do. So this is going to be our class. In the next class, session number 2, our homework review is going to start with the discussion on the quantitative practices of how we're building the skills, and then qualitative practices as to how we build the skills. I'm going to give you 2 articles today that you will have to read for next week, and then we'll have that discussion. We will review the current game, which is bias game number 78. Then we will review the anatomy of the trade, or rather define what stock we're going to trade throughout this semester. So in the last 2 or 3 semesters, what we've been doing with students is where we would pick one stock and the whole group would just trade that stock together. So it's been very helpful for students just to kind of experience that week to week analysis and trade execution, and having that group input and my input as well into that segment. So this is going to be great. Then our first exercise in session number 2 is going to be action sequence exercise, where we're going to put on the chart, and then I'm going to have the volunteers, and we're going to go through the chart together and just unfold the chart and analyze it and trade it. All right. By the way, just want to quickly say that this session is being recorded, and we're going to post it on the YouTube channel tonight. So again, for those who are guests and you guys, let's say, cannot stay for the whole 2.5 hours, don't worry, it will be there. All right, so here's our first homework. So for those of you who are already students, or for those of you who's going to sign up, please pay attention. So your first homework is going to be just to read these 2 articles on the ways of how we're practicing. The first one actually is not an article. It's a chapter from Malcolm Gladwell book, Outliers. Quite a lot of you guys read this book. Quite a lot of you read other books. And students usually give me some kind of, other alternative sources for that particular chapter. The chapter that we're going to concentrate on is going to be called 10,000 Hours. This is where the discussion about the quantitative practice is taking place. And then the second, this is a true article, it's called The Mundanity of Excellence. It's the article about the practice by Olympic swim candidates, and the differences between those who make an Olympic team and those who don't. And we want to extract the best ideas from these 2 pieces and then kind of combine them together. And we will have a discussion, and we'll have some volunteers, going through this exercise with me, where, we'll try to establish with that volunteer what the number of hours, and, what are the qualitative ways that particular person, is going through their practices. So it's going to be very important. It's a very intentional exercise. We are basically going to set up the whole tone for the whole course. Obviously, a bias game. So a bias game is going to be a weekly homework. And I would say that from all of the homeworks, the bias game is the one that I really, really, really will force you to do. This material, if you are just watching it, if you're just an observer, it's totally fine with me. I mean, again, if you're just going to say to me, Ramon, listen, I've got a lot of things going on in my life, but I really would like to attend your course. I really like it. So, but I'm not going to submit any homeworks. This is totally fine. I just want to know the rules of engagement for you, so that I would push the people who are saying to me, like, push me. I want to go to that next level. And the only way how you're going to go to that next level is through the experience, through the experiencing the course, experiencing, going through the homeworks and actually doing something and making mistakes and then coming back to the group emotionally kind of down, and then looking and searching for answers. That's the environment that we usually have in the classroom, whether this is WTC1 course or WTC2 course. And this is the work that students do in this course. So bias game is going to be somewhat mandatory for those of you who are going to say to me that, yes, I want to be pushed. And you guys already know me. I'm not, I'm a very nice guy, but I'm gonna push you as much as I can if you allow me to, and if you will tell me that this is what you want. All right, assignment number 3. I want you guys to think as a group and pick just one stock. And obviously, we're gonna have different stocks from different people, but in the next class, we're gonna get together and we're gonna say, okay, so what stock would you like to trade this semester? And I want you to think about this for a week. And in the next classroom, I'm gonna ask you this question, so you should be ready. Um, that will become the anatomy of the trade segment for each class. So we will have the real-time market position or a stock position that we will discuss and voted by the class. And actually not necessarily voted, but each and one of you is going to kind of like do their own thing. It was very interesting how last semester we were trading Tesla. And it was a great stock to trade. Why? Because at the beginning of the semester, it went into the consolidation. So it was extremely hard. And we could see how some of the, let's say, mean reversion, consolidation type of strategies were working so well, especially like something, with options trading that was just phenomenally good. And then we had the directionality coming out of that apex formation. And people made a lot of money on that. Obviously, we are not giving an advice here. It's up to you how you use those discussions. But I was trading Tesla as well. Was probably one of the better trades in the last quarter. That I made. So it was kind of fun to discuss it in the classroom and to make money. Again, this session is being recorded. This is a very common question as we go through the material. So for those of you who would like to watch this video again later on, go to our YouTube channel. I will post these 2 articles for the homework tonight on the class page. And you guys, the students will receive the access information to that page tonight, probably after 8 p.m. Pacific. All right, so that's the homework, but we also have one more homework from WTC1. So majority of the students, and this is so interesting how this class is being created, right? So what kind of students do we have? We have WTC alumni that are coming to this class and they're continuing their studies, and now there is an expectation of the build-up of the skill base. So this is exactly what we're going to do. And our last homework in last semester was to take Biogen stock or any other instrument or stock. And I've seen some of the homeworks that already came in, so thank you guys for that. Some of you even sent some trades, historical trades in crypto. So that crypto assets, that was very interesting. And you just basically backtest the Wyckoff trading plan that I gave you at the end of WTC1 course. Very basic. I don't want over complications unless you want to. Very basic ways of how you just take the knowledge and go through the exercise. So for those of you who have not done this work, we will be discussing it in the next class. And actually, we'll kind of go through some of the visual backtesting steps with Biogen in the next class. So please make sure that if you want to do this homework, you start early on, because it takes time. It takes time to go through the whole history of the stock, to identify, the points of analysis, the points of entry, to manage that trade, and so on and so forth. You could do this in different ways. You could just basically, put the chart on and identify the spots and the reasons why you would get in. You would not get in, and so on and so forth. Or you could go bar by bar. You could also switch time frames, entry on the daily, switch to the weekly, and so on and so forth. So I'm thinking that session number 2 will kind of devote a considerable amount of time to this particular exercise because there were quite a few questions. And for those of you who already have some questions, and I've seen some questions in the emails, make sure that you send those to me again, or if you have a question, please send that. We will definitely address this. All right, our market update. Let's quickly go to our setup. This is the usual setup. This is just my setup that I have for all of the markets. At the top, we have all of the indices. Then we have silver, gold, Bitcoin, and oil. So those are kind of like the major 8 that I usually look on the daily basis. I do trade quite a lot, especially in 2020. I trade different time frames, campaign, swing, and intraday. So you can ask me any questions about those time frames. And I trade stocks, options on stocks, and futures. So, and this year I'm going to start trading cryptos as well. So you kind of could ask me quite a lot of questions on different asset classes and, different time frames as to how we, would be trading them. So let's have a quick look as to what is going on. Well, I thought that yesterday was a very interesting day where supply has increased for sure. There was an emergence of the supply, first true day, in the market place, to trade in 2021. We're seeing how the downward spread has increased. There is an attempt to commit below the last up bar right here. There is no commitment on S&P above the last significant bar. And that's what's so important. Whenever you have the emergence of the supply, the biggest question that you should be asking yourself is this supply going to be absorbed, or is it going to produce some kind of downward result, which is going to be meaningful, which is going to come into some kind of fruition, where we're going to see a change of behavior? Well, what do you see, guys, here? Did we have a change of behavior? Did we produce a price structural collapse that is maybe more of the distributional qualities? You are all saying no, and I would say the same thing. So if we're anticipating some kind of move down, we still need to see a little bit more. I would say that if we're going to start having some commitments below this line right here, and especially below this line right here, that signifies some of the more prominent supply that came earlier, the areas where supply was somewhat aggressive, there was some profit taken, and yet there was no significant result to the downside. If we are closing like this and then following up, then that would be significant for the price structural analysis. But if we are showing some emergence of the supply, and each time we recover from that, and we are recovering from higher grounds, from the higher low, higher low, higher low, this is still constructive, and this is just the nature of trends. Trends are going to have a multiple variations on how supply occurs. You might have a lot of people that have already made a lot of money, and they need the cash from whatever assets they have in their portfolio to buy something else, or maybe just to even stay in cash. So whatever they're going to do, they're going to come to the market, they're going to profit take that cash, from their portfolios, from their positions, and that's what's going to produce that, quick move down on a day or two. And all we have to do is just to concentrate as to what kind of damage that supply has produced. And so far, we don't see a lot of damage. And we're definitely in the environment where conditions maybe are not that favorable, for immediate continuation. What do I mean by that? Well, look at the Dow, right? So we're trying to get out of this formation. We're failing once, twice, third time, fourth time, and now fifth time. So this becomes a little bit of a suspect as to, could we continue an upward movement right away? But at the same time, until we actually break this pattern, we can't really say that, something is going on. We really have to have a confirmation. So a lot of the mistakes by traders in the uptrends especially are being made during the conditions, let's say, that are overbought conditions. But in a lot of cases, uptrends are going to sustain those overbought conditions for some time. And then out of that condition, there might be some reaction, but it still might be within the structure of a much larger trend. So my whole view of the markets right now is that since the COVID lows, we are in the new uptrend, which is a continuation of the secular uptrend from 2009, and we just had potential reaccumulation. We broke out of this pattern, and now we're kind of drifting up. And there is just some news that is still ahead of us, some news catalysts, like, tomorrow is going to be a big day. I think that tomorrow we're going to have, increased volatility, just based on a lot of things, election related. Um, and we will have to see how the market reacts to that. But so far, I don't see distributional qualities in the bars that came just recently on the increased supply signatures. If anything, you should be comparing these bars to the one where we had the profit taken and where we had the rotation from the, let's say, growth or the tech stocks into value stocks, or the distributional pattern itself, COVID distributional pattern, where we have the distribution on the way down. So those are completely different spots with completely different characteristics. So until we have one or another, we're just sitting tight. We're holding our hands, under our buttocks, and we are trying not to do anything and just managing our positions. That's all that we do. Sitting actually makes money. All right, let's go to other markets. Well, gold was a very interesting puzzle at one point, and then it became a little bit obvious. So I'm going to talk to you about, the spots that were somewhat difficult. I thought that, this particular bar was of utmost interest. Why is that? Because it basically suggested, it gave us a hint of the bullishness of this pattern. Why would I say so, guys? What am I implying here? Well, let's have this quick conversation, and you could just type it in the chat box. Okay, John is saying no follow through. Absolutely. Francis is saying effort versus result. Absolutely. So what do we see here? Iqbal is saying result is poor. Sunit is saying stop in action. Rob is saying failed intent. Limited result from Philip. You guys are so good. Yes, look at this support level that we had created at the previous two important lows. The first low was a change of behavior low. So that kind of defines the whole trading range. It defines also the stop in it defines a confirmation for the stop in action of the climactic run that we have had into the buy-in climax. And that suggests the change of the environment into a trading range. and we are having a down sloping trading range right here where we are having lower highs and lower lows, and that's what produces the change in the sentiment. And a lot of people would be thinking about this as, that's it, gold is done. And much more educated people are going to say, indeed, it's done. Why? Because we had that climactic run. We went into this overbought condition. We had that overthrow. We had that climactic action. We had that change of character, but not so fast. Why? Because we still have to see some kind of confirmation. If you're thinking that this is downtrend, we need to see that confirmation. And I thought that this particular bar gave us such an, subtle hint to the bias itself. And then we just needed to find that confirmation, either conditional or structural, as to how the whole structure is going to unfold. So what is it that we saw on that particular bar? And this was the discussion in these classes, in all other classes. If you guys remember, we've talked about this. The volume signature increases. So let's kind of build our volume equation here. So volume is increasing, it's a volume spike. Because it's a downward bar, definitely supply is increasing. But because this is a spike itself, what is demand doing? Let me do this as a pop quiz for you. What is demand doing here? Is demand increasing or decreasing? Absolutely. All of you are correct. Demand is also increasing, but demand is not necessarily increasing at the same rate as the supply. So supply is still dominating over the demand. And our expectation on this dominance is that there's going to be some kind of continuation. And we just need to see what kind of character of that continuation we're going to have. And somebody was saying that there was a limited result, there was a poor result, there was a stop in action. We are stopping here at the support level on such aggressive emergence of the supply. Why would we do that? Well, that's only because demand is present and demand is increasing. So that increase of the demand is suggesting that we are somewhere close to the stop in action. We are somewhere close to the change of behavior. We are somewhere close to the potential reversal and maybe change of environment. Well, we've been in the trading range for some time, so this does not apply. So all of the rest applies. And the only thing that we're thinking short term is continuation and what kind of character of that continuation we're going to have. So what kind of continuation do we have? Spread decreases into the area of the support that was defined by the previous points, and this support and resistance are just well defined at that point. We're seeing also decrease in the supply signature itself. And if we would deconstruct the whole portion of this swing, we're going to see that there is not a lot of supply here at the beginning, so there is not a lot of selling there. Then selling comes, and then selling diminishes. So supply relative to that big bar is getting exhausted in the area of the support, and that is suggestive of a rally. And what a great call we made right here, right on this bar at the bottom. And we said, this is potential bottom. And we, at least at the minimum, we're going to have the rally to this line right here, which is just a long-term resistance line. And we would need to see what kind of character we're going to have on the way up. If this is going to be the character where we see not necessarily just, a very aggressive demand, but a very aggressive result, meaning that we're covering, let's say, the majority of the selling that has come at this point, then most likely this is a bullish case scenario. So this bar right here had that hint on the low result as to what's going to happen next, both short term in terms of the continuation of this reaction, and then in terms of the rally that we're going to have. And then the rest was kind of like easy, right? So we have some supply coming in, but it's not that aggressive. It diminishes really quickly within a couple of bars. Then we have to have, the absorption of the supply at the higher level. That supply comes even at the slightly lower level. And, the latest call that I was talking about in WMD classes was on this particular bar. This bar suggested that we're going to have a breakout. just because the level of the supply has contracted so much. And that supply came not at the support level, but close to the resistance. So, our call was that not only we're going to have a breakout, but most likely we're going to have a successful breakout. So gold from this point of view was kind of interesting at that big bar, and then it became a little bit obvious. Okay, but silver was interesting from the perspective of the outperformance over gold, and silver obviously has been such a great trade. I'm going to show you my trade in silver. This is a campaign trade. I believe that we're going to see much higher prices in silver as we campaign the stock, not swing trading, not intraday trading, but campaigning the stock. Silver has been outperforming gold, and out of this formation, phase C, we're seeing much better rise. I'm using a lot with silver the analog from 2010, where we had the same type of the conditions during 2008, 2009, decline and the low, where we rallied, and then we had this 1, 2, 3 or ABC type of the reaction into the oversold condition, from which we have rallied to the highs of that particular rally. So I'm expecting silver currently to go to 27, maybe slightly above, and then consolidate in the upper part of that consolidation with an idea of the resumption of the uptrend, and then going into a more speculative phase. And this is where a lot of money could be made on the way up. So I'm kind of expecting that we're gonna, touch, a lot of this prices as we go up, as we're already right here at this point. And by this point, I mean price-wise, not the structure-wise. Structure-wise, we are somewhere here. And this would be the next expectation. So let's see if we're correct on that. And again, I'll show you that silver trade. But, if gold and silver provided some excitement, I think the most exciting asset obviously has been Bitcoin for quite some time. And I just want to concentrate on the last, price action. It definitely looks climactic. There is no doubt about that. But when you have so much interest from institutional traders in the asset where they did not have a position before, how do you think the price is going to move? And how do you think they're going to accumulate that asset? They're not necessarily going to accumulate it during the consolidations, even though we do have quite a lot of evidence that even during consolidations, institutions increase their presence and increase their bullish outlook. Our call on Bitcoin, and again, check out Alessio's work. He's just so fantastic with the cryptos and his analysis. We were analyzing an analog in these two areas, and we said that there's gonna be a rally from this area, and then just based on our analysis around this area, we said this time it's gonna go up and it's gonna continue. And Alessio has some targets, to 35, 36,000, maybe even slightly above, and there is much higher targets that he's shown me, into the 40, 50,000. So we are not done campaign wise, but we are definitely overbought and in the climactic run here. So what I would do here is I would concentrate on the much lower time frame, maybe like hourly at this point, and I would do a lot of tape reading here, where we're looking at the specific bars, identifying supply signatures, trying to see what kind of result we're going to have. And it seems like yesterday that result was a big bar to the downside with the big spread. But yet, look at the close. The close is actually at the same level as this climactic bar. And then the tail into the close is just tremendous. So that quickly reminded me of this situation where we had a call here that short-term conditions were deteriorating, and we would have some kind of change of behavior, which has happened. But the change of behavior suggested presence of the demand and suggested that even though we are going to go into the consolidation, and we call that this consolidation is going to be upsloping. So, and to me, those type of calls are, the most exciting calls. It's not the call on the bias, it's not the call on the timing, but it's kind of like a little bit more advanced analysis where you could forecast the structure itself, what shape the structure is going to take. So that was the call, that we're going to have that upsloping higher highs, higher low structure. And the another call was that the duration of that structure is not going to be that significant, and we're going to resolve it pretty fast with the acceleration on the way out. And that exactly happened that way. So at this point, when we look at this bar, it just still shows a lot of demand. So still a lot of institutional types are believing that Bitcoin is going to go higher. And I think that they're thinking, about FOMO, the fear of missing out on this trade. So they are willing to go in at such higher prices, and there is enough liquidity now for them to operate in this asset. And that's what's basically happening, and they're supporting the prices. So to me, this is all about a lower time frame. If you are in Bitcoin and you're trying to get out, at the most optimal price. Although it is definitely, a much more significant change of behavior that we have had with the test and then a very quick recovery. So step by step here, I would be protecting my profits, but would be protecting them in a very, very intelligent way, allowing the Bitcoin and other crypto assets to move if they will move even more. All right, oil. Yeah, let's do oil as well. So our expectation, coming out of this formation was that the bias was up. We've identified, the buying at the sprint position. That was buying number one. Actually, a lot of buying has happened prior to that. We've talked about this bar right here with a lot of demand. This is the stopping action into the support of this wedge formation. So it kind of showed that same gold type of the aggressiveness to the downside, and yet no result, or no extended result. Successful test on lower supply signature, and then supply is increasing, but increasing only locally from phase B to phase C. But overall, globally, from phase A to phase C, we see deterioration of selling. And behind that sprint, there is some increase of the demand as well. And as we are testing that assumption about the bullish bias, then we have a very nice confirmation in this bar, which happens into one half of the trading range, and that is a repeated buying. And it is even more aggressive buying than what we've seen at the support level. So think about this for a second. They are repeating their buying, and they are more aggressive at the higher level. So what does it mean? Bullish or bearish? And then also think about the character. If they are so aggressive in the middle of the trading range, which is where, big institutions are not preferably would be buyers, right? So for instance, you would see a lot of buying right here, and then the buying would subside, and we would see how the volume signature would go down. But here, they are buying on the way up. So they know something that we don't, and they're just basically advertising on the tape that not only this is going to be a bullish bias, but character-wise, it's going to be a much sustainable rally with a lot of aggression. Well, we definitely have seen aggression on the way out. This was a really good breakout above the trading range resistance. We're breaking out quite decisively. We're also breaking out decisively above the highs of the previous, level of the resistance. And this is where, the predominant buying has stopped. And with that buying, stopping of the buying, we kind of see a slight deterioration of the momentum. And the whole idea here about the deterioration of the momentum was that we are going to have that reaction. And we are probably going to have the reaction into the body of this value zone. And what do we see? We only see a touch of that zone. And that, again, on the emergence of the supply, suggests that demand is somewhat strong. And it doesn't allow the price to go lower. And that confirms the bullish bias and still confirms the aggressiveness of this rally, which we have seen, as a resolution in this latest, 2 days. Now, today was not necessarily the best day. And you might be asking, well, how come? Right? I mean, don't we have the volume signature confirming that the demand is there? Yes, for sure. But, look at this volume signature. So the effort is almost the same, practically the same. The spread, is slightly less. And not only that, if the intermediate high here is being overcome a little bit better, look at what we're doing with this particular bar. We are committing to the upside, but we're not doing this as much as we've done before. So there is a little bit of the deterioration of the demand, or rather the result that demand produces in the way how the price travels. So we may be somewhere close to a little bit more meaningful reaction, maybe a reaction of kind of like this magnitude or this magnitude, this magnitude, this magnitude. All of the smaller reactions have produced their own kind of like structure, and now we have to be a little bit more cautious, but again, extremely bullish outlook, extremely bullish behavior overall. All right, guys, that's it for today's market analysis. Let's see where we are. We are at 4 o'clock. All right. I've mentioned WMD classes. So on Wednesdays and tomorrow, specifically, we're going to have a free class, as we have the free classes this whole week. This is the beginning of the semester, so we have open doors to all of our classes. And I've mentioned that I teach that with Bruce Frazier. Please check his blog on stockcharts.com. And also the power charting videos that Bruce creates each week. And those are posted on our YouTube channel, and you could find those on Stock Charts as well. Bruce is deeply equipped with all of the Wyckoff concepts. He is an unbelievable teacher on Wyckoff methodology and trading in general. I would highly recommend you go through his blogs. You could read them as a book. Just go one by one, and you can kind of like establish the thinking that Bruce had at that point. And those are blogs and kind of like both theoretical and applicational blogs, where he shows some of his calls and then also just talks about the concepts. And then together with Bruce, each Wednesday we go through the market analysis, where we go usually from the top to the top-down approach, where we look at the markets, we look at the sectors, we look at the groups, we look at the stocks. We have a lot of segments, like scanning segment, which is recurring segment, communal Wyckoff watchlist, anatomy of the trade. I'm missing something here, but students chart submission, so you could submit your work where you label the chart, and we give you some kind of pointers on your analysis and give our overview. So check that out. Tomorrow is a free session. All right, so now let's go into the material for this class. And we usually start our discussion with two things. In the next class, we're going to talk about the quantitative practice versus qualitative practice. And then we're going to have this kind of like interactions and discussion about, well, how are we going to approach this? How are we going to establish our practices in this class? And then the second most important conversation that I usually have in all of the classes, maybe more so with this group, because you are more advanced, you already versed in all of the concepts, all of Wyckoff concepts. So it's the conversation about observations and deductions. And I've been teaching this material already for quite some time. This is actually the 10th year that I've been teaching this material, and specifically, I think we're close to the 30th cycle of these classes. So I'll have to double check on that. But the main issues for students that I see in their analysis, not trade execution, not the process itself, but in the analysis, is an ability to observe and observe correctly, and then an ability to make deductions or deduce what you see in the observations, and then from those, those deductions bring you to some kind of clear idea and clarity about three things: bias, timing, and character. And usually, and I hate to say this, guys, but majority of you, or I should say majority of us, but majority of you, majority of students just generally lack observational skills. That's just unfortunate truth that I have to face as a teacher and you have to face as a student. We're just not very great observationalists. If you go out on the street, how many data points can you observe? I mean, are you gonna look at the tree? What are you gonna notice? Are you gonna notice the colors? Are you gonna notice the structure of the tree? Are you gonna notice smaller details? Are you gonna notice the location? Are you gonna notice what's happening around the tree in the moment of the observation? And all of those elements might have so many other observations that needs to be done. So market is kind of like that. We have a lot of data points that we need to look at, and we need to extract those data points from our observations, and we fail to do so in a very kind of efficient way. And even if we do so, a lot of those observations is non-objective. They're a little bit more subjective, and I'll explain this to you. So, for instance, in our analogy with the tree, what are you going to be attracted to when you observe a tree? Well, maybe someone is going to be attracted to the colors because you're more attracted to like the color gamma of this whole observation. Somebody is going to be looking more at the structure, like the branches, the leaves, the roots, the bark, and so on and so forth. Somebody might be just looking environmentally at this observation. So you will be noticing some people, having lunch below the tree, maybe a boy just, doing something, and so on and so forth. So observations become very subjective. So when we come to the marketplace, we do the same thing. We put our subjective view as to what we exactly observe, or rather, we put the weight more on the specific observations. If you happen to have a lot of losing trades where, let's say, or maybe not the losing trades, but maybe like earlier exits where supply comes in and that produces a significant bar to the downside, and you kind of go with that and you exit on that bar, not waiting for the secondary test, for the testing of that particular high that was reached before, then you will be prone to that subjective observations and behaviors. And you have to go back and revisit those type of trades, establish the commonality of the mistake that you are making in your observations, and then try to correct it. And for majority of people, it's even incomprehensible to think about this way, to think about the analysis in these terms. Well, how is it that I'm not observing, objectively, or how is it that my observational skills are lacking? Don't I see what I see on the chart? And in the majority of cases, 99.9%, I'm going to say yes. You are failing to observe what's happening on the chart. Either you're failing to observe all of the necessary data points for us to make a correct deduction about the bias and the timing and the character, or you are making your observations in such subjective way where you're putting the weight on the specific elements of your observation. So you need to correct that. And then sometimes we're just not observing enough. And actually, it's kind of interesting because with the advanced traders, and let's start with the beginners. With the beginners, I actually want them to be overwhelmed with their observations because I want them to learn how to make those observations and to observe as much as possible. With the advanced traders, what I'm doing is I'm trying to push them to observe quicker, faster, but more objectively and go right to the observations that matter. That's what's important because you have such an overflow of information that the market gives you, not just on the number of stocks, but even with one asset, when you look at the chart, how many points of observation do you think you're going to have? Thousands of points. I mean, like if you're truly observing whatever is on the chart correctly, you're going to have thousands of data points that you can, observe. And, it's extremely important skill for a great analyst to do exactly that, or for a trader that is basing, his or her decisions on the technical analysis. And then the second problem that we have, and it's not like, oh my gosh, there are so many problems and now there is another one that you're bringing to my attention, but unfortunately I have to. Majority of us just do not know how to deduce correctly what we're observing. Well, if you're observing, let's say, some colors on the leaves of the tree, that maybe are kind of like changing from the morning colors to the evening colors. Can you tell and deduce what time it is right now of the day? Could you deduce by the observing the bark of the tree where is the north, south, west, and east? I mean, these are the type of observations that are needed, and also deductions that logically has to be built in our minds in order for us to make a correct um, decision, anticipation of what's going to happen next. Yes, I see that maybe the colors on the tree show that we're closer to the evening, so the night is upon us. That's the trading decision right there. And usually, traders and students just generally interpret observations incorrectly. So what we're doing in this class is that we're trying to establish the correct observations, what needs to be observed, to what degree, what's important, what's not important. And then we have to understand, how do we actually make a deduction out of this? What the deduction is going to show us. And then after that, we have to systematize our deductions, right? Because if we have a lot of deductions and they are, the biggest problem is different time frames. So on the short-term time frame, our deduction could be that we are bearish. But then on the longer-term time frame, our deduction could be that we are bullish. So how do you reconcile this? You have to have a systematic approach for this type of situations, and majority of people just don't have it. Not only that, I mean, like if I'm going even further down the road and, with all of this, assumptions here about what a usual regular trader has or doesn't have, I'm going to say that not only observational and deductive skills are not present there, but most likely even at the core, the beliefs about how the market functions are not there. Or maybe they are just partial. Maybe they're not complete. Maybe they are changing all the time as the student kind of like jumps from one material, from one methodology to another. Although all of the methods, if you could believe this, are talking about the markets, predominantly about the same thing. We're not reinventing the wheel here. The human behavior, which is basically a reflection of the market, is going to be the same. It has been the same 100 years ago when Wyckoff, originated and codified all of those rules. There is nothing that has changed. As I say, people are people, meaning that people don't usually change. We're just becoming either the better version or the worst version of ourselves. So we need to have some kind of belief systems that are systematized, and then the rules that are being extracted from that system into a trading plan, and then we execute. And we execute on different levels. We are executing just basically, systematically, so the mechanics of trading. And then we are executing on kind of like a self level, right? So those are the two things that you need to come to and be extremely comfortable with trading. And a lot of those beliefs, initial beliefs about the market, are somewhat counterintuitive to the nature of a person. Because in trading, we lose. And as people, we don't want to lose. We want to hunt, collect everything, hoard everything, and keep it. Trading does not allow us to do so because it's an uncertain environment. So, unfortunately, this is the biggest struggle in trading. It's not even the mechanics. It just you going against yourself, your own nature that has been, created not even by you, but for you by previous generations of people. You are so kind of like, it's so ingrained in you, in your DNA, that you have to change, and this is the hardest work that you could possibly do. And then obviously, we've talked about, not systematizing those deductions, observations, and then the weight of evidence is just poorly developed, just based on that. So, it's all about kind of like making incremental steps to progress in your trading, where you have a lot of failures, and you have to recognize, and I'm going a little bit on the side note here, you have to recognize that those failures are great. What am I talking about? Why are failures in trading are so great? Well, let me just kind of like extend this a little bit more. If you lose money, it's great. If you go into the drawdown, it's great. If you don't understand something, it's great. Why it's great? Because if you are at least somewhat of a conscious person, and this is a big problem on its own, by the way, just to become very, very conscious and have a lot of clarity about what you're doing with trading. If you're a conscious person, you will see those failures, those mistakes, as an opportunity to understand what else needs to be done. And if you don't give a lot of emotional weight to that, if you don't collapse under the weight of emotionality of that failure, you will find the ways how to get to the correct material, how to get to the correct coach, teacher, how to build a correct system, how to extract the correct rules, and how to adopt those rules to yourself, to the person that you are. I am a completely different trader than all of you, and you are a completely different trader than everybody else, just because of who you are as a person. You're going to have your own rules. You're going to have your own system. You're going to have your own beliefs. You're going to be basing, your trade execution based on who you are, not who Raman is or who other people are. But we're definitely on the same path. And that's what makes it so much exciting and easier for us when we are in the group, because we help each other see ourselves? Well, here is the first exercise for you. I became a little bit, esoterical. So, but those are all very important thoughts. So hopefully, guys, you kind of hear me, right? And you hear what I'm talking about. And even for those of you who come back, to this class for, let's say, the fourth and the fifth times, and we do have people like that come back to us, for the fifth time, for the same class. If you don't recognize that your observational skills are still need some work, then you are failing right there. If you don't recognize that you need to increase your deductive reasoning, then you are failing right there. So hopefully you do, and hopefully this talk kind of like pushes you to recognize this and brings you a little bit more awareness to this problem, and also sets up an intention for this whole course. Because these are the people who I want to work with. I'm not interested to work with people who are going to be asking me in this class, let's say, well, here is this trade, and I'm just can't really put together what's going on. I want to hear what you think about it. I want to hear you telling me what is going on with you, and let's actively decide this problem together. So that's the intention for this whole series. This is intention for this whole course, and hopefully I've got you on a serious note here, and we're going to start doing this work. So here's our first work that we're going to do, and it's going to be based on this discussion about observations and deductions. I'm giving you here data points. How many data points am I giving you guys? What do you think? Give me the number. What do you think? 6, 12, 4, 6, 6, 6, 3, 8. Okay. All right. So what are those? 15. Okay. Less than 12. Interesting. Or more. Okay. I'll accept all of that. So far we have 15 as the biggest number here. Okay. So let's talk about the data points, right? So what do we observe on kind of like a very rudimentary data level? So a lot of you are saying, okay, open, high, low, close, and volume, right? Okay, absolutely. So we have, this is the close, this is open, this is the high, this is the low, this is the volume signature. So 1, 2, 3, 4, 5. And because there are 3 bars, 15 points. Can we extract more information? Can we extract more data? Maybe this data becomes a little bit more complex, right? So what about the increase or the decrease in the volume signature? Would that be a data point for us that we could use for our analysis? And we could put this under the observational skills, and then we could deduce something what it means in the relationship to how the price moves, right? So if we're doing that, then could we possibly do this with the bars, right? What about spread? The extension of the spread, right? So for instance, the difference between the high and the low. What about the difference spread? What about the spread between the close and the open? What about the difference between close of bar number 1 and close of bar number 2 and close of bar number 3? Something like that. What else? I mean, like, if you now think about the data points from that perspective, then what else? Okay, let me just see. Position of the close, yes, absolutely. Position of the close relative, let's say, to 1/2 of the spread. Okay, position, of the close to the close, although this is the one right here. Colors of the bars, absolutely. So colors are going to tell us, just the bias for the bars. Context of the market, that's very interesting. Amount of the retracement, tails, progress, follow through, absolutely. So now you have kind of like this secondary layer of data that you can observe. It's almost like when you look at the tree, can you maybe like zoom in a little bit into the bark and just say like, oh, I see that the bark is showing the age of the tree. I just been on the walk in the forest with my family on Sunday, and there were a lot of oak trees there that had a lot of, and they were really old. So you could see and you could observe the differences in the bark of the tree, and you could make some deductions as to how old this tree, what it was facing, what kind of environment it's in, and so on and so forth. So we're kind of going to that level. And then, imagine the level beyond that, right? So we could say, and I'm so happy that somebody has mentioned this, what about, just um, some kind of deductions out of the relationship between what we're observing in price and volume, right? So let's go into that. First of all, what do you think the bias is right now for the formation of the 3 bars? Okay, so majority of you is saying bullish or up. Absolutely, okay. Why would we say so? Where does it come from our observation that this is, a bullish bias? Effort result, demand exhaustion, demand, effort result, then retrace lower volume and higher low, highest volume falls to get momentum down, effort versus result, no commitment. Well, we could even, and this is again, this is a conversation about efficiency, right? So a lot of you are just going through your own things and kind of like showing me your logic as to how you observe these 3 bars. Uh, well, for me, I'm looking at the most significant bar in this in this troika, and that is obviously this bar right here. Why is this the most significant bar? Well, because it's the largest bar, and it has a very well established bias, and it comes prior to the other 2 bars. So it kind of establishes the bias for us. We do not know what was there before. We could only guess. And the context could be different. We could be in the uptrend, we could be in the downtrend, but this is the data that was given to us. So based on this data, this is the most dominant bar. It's an up bar. So our bias, unless this bar has been reversed significantly, is still going to be bullish. Okay, well, let's talk about the reversal. What about the second bar? Is this a bullish bar or a bearish bar? And here we kind of 50-50, right? Somebody's saying bullish, somebody's saying bearish. Majority of you are saying bullish. For those of you who said bullish, why do you think this is a bullish bar? Indecision bar, neutral. I like this one. Mike is saying Is it Mike? Let me just see. Rob is saying, supply couldn't push the price down. Short-term bearish, but bullish. Alex is saying. No ease of movement, John is saying. Poor down result, Iqbal is saying. Lots of supply pressure, but little progress, Sunit is saying. Gaurav is saying supply, but result is weak. So it definitely looks bearish from the perspective of just what's happening with the effort. Effort is increasing, and we're definitely pushing down. So there is a pressure to push the price down, and yet, what is the result? The close is at the same level, and then the progression of the tail is only limited into the body of the previous significant bar that we've established is one of the most significant bars there, right? So I would definitely accept it's a short-term bearish bar that identifies that supply is present and we could expect some kind of reaction. But from what we see on the result part, the result to the downside is not really that big. So we're thinking that whatever the reaction is going to be, it's going to resolve bullishly out of this situation. But we are expecting a reaction. Well, the reaction comes on bar number 3, and what could we say about bar number 3? Talk to me about selling. What do you see with the selling? Is it increasing? Test on lighter volume. Exhausted selling, decreased, less, reduced, decreased in selling, no, diminishing, decrease in selling. Yes. So selling is decreasing. We see that from the volume signature. How much is it decreasing? I mean, you really have to think in those terms. You cannot just observe kind of like on the surface. You really have to think and put a lot of thought into, like, if you're saying that this is a decrease in selling, how significant this selling is decreasing? And what would we be comparing it to? Well, obviously, we know that some selling came on the previous bar. A more hidden selling came on the bar before, for those of you who see that. And we kind of seeing how selling increased on the bar number 1, selling increased more on bar number 2, and then selling has decreased significantly on bar number 3. So we know that there is a little bit of the exhaustion of selling. Tell me about buying on this bar. What is happening with the buying? Is there buying on this bar? Let's start with this simple question. Is there buying on this bar? Is there demand present on this bar? Yes. Okay, now we established there is some buying. How do we see that buying? Lower tail, demand tail, absolutely. So we see that as exhausted selling came, it produced the reaction. And it produced the reaction on this bar still within the body of the main bar that we have. So we are not undermining the commitment line, which is based on the low of the most significant bar on this chart. We're just basically reacting within the body, and then we're closing into one half of that bar, and we're creating that demand tail. So buying is there, and if there is demand that is coming in, now think about the constitution of this volume bar. So we know that volume is diminishing. This is a downward bar, so we're going to start with the supply. Supply is diminishing, and demand is perhaps either diminishing or increasing. And I'm going to make the case here, for both. Why? Because if we would be thinking that, this bar right here, what would be the volume signature there? We probably thinking supply is increasing more dramatically and demand relative to the previous bar is decreasing. So if the demand is decreasing here, on the next bar, there might be an increase of the demand signature. We would only see, a much clearer representation of the demand on the tick volume uptick and down tick volume. So here we kind of, a little bit puzzled. But even understanding that this puzzle exists there gives you, kind of like a better information than anything of a poor observation and poor deductions. So now when we come back to all of this, and we are basically saying, with all of those observations of the data points that we made, with all of those deductions that we went through, what do you think is going to happen next? It's very interesting how you guys right away became a little bit silent. It took you some time to think. But why are you thinking about this? Didn't we establish that bar number one is extremely bullish? There is some kind of, when we just kind of assuming here that there is some kind of expansion of the volume demand, of the volume signature. Why would we even say that, or deduce that there was an expansion? Just because of how contraction has happened after that. Then we're seeing the expansion of the result to the upside, so which suggests definitely contextually we are in the uptrend, we are in the upswing. Whatever supply comes in as a counterforce to that produces limited result right away, but suggests short-term reaction. Short-term reaction happens, selling is being exhausted, and demand is present. What's to think about there? So I'm going to tell you my kind of like idea of why it took you a little bit more time to think about this. Because in some of your minds, there is kind of like a chatter that's going on. It just basically chatter about, well, what about that? What about this? Don't we have like 2 down bars with the supply? What if that's going to change? Isn't this also some kind of pattern, a candlestick pattern where the reversal is happening? Isn't this like, I don't know exactly those candlestick patterns, morning star or shooting star, something like that. So one of the things that we're going to establish in this class, in this course, is what we've been working with our students in the last 2 semesters, and that is a flashcard mentality. What does it mean? It means that when you look at the chart, you need to observe specific points, and there are quite a lot of points as we, deduced here, right? It's not 8 points of observation, although it could be if you're just observing those. It's not 15, it's much more. There are so many more observations that we could make about these 3 bars and 3 volume bars. And yet, we want to establish that process of observation in a kind of like this flashcard mentality where we're going for the correct and the most objective, the most influential observations that we could possibly make. And when we are practicing this in our mind and repeating this process over and over as our analysis, then what that habituation establishes is an ability to think correctly in terms of what we observe and how we deduct or deduce, what the outcome is going to be. Now, the problem even is not that, right? The problem is this. How many data points do you see here? How many data points do you see here, guys? Give me a rough estimate. I know, a lot, right? Infinite. Hundreds. Too many to count. Need to filter out the notes, thousands and thousands, a million, hundreds. Yeah, right. Okay. So how about this? Let's change our mentality right now, and based on the knowledge that we've got from WTC1 course, and this is going to be a challenge also for the alumni of this course as well. What are the main observations that you can make about this chart? How about this? I'm going to give you only 5 observations that you could make. Flashcard mentality. What are the most important 5 observations that you can make about this chart? Iqbal is saying bias is bearish. Iqbal, why the bias is bearish? Let's deal with this first, because obviously when you would be thinking about the bias, you would be thinking about the background, right? So in background is contextually extremely important to us. So Iqbal, why the bias is bearish? Wipes out the gains. Okay, so we are starting from here and we are having a big momentum move up into the climactic high. This is a climactic high. And then we're having an upslope in trading range, which is a distributional range in nature. So we are actually up to this point making higher highs. So what is the background for this particular chart? I would say it's probably bullish. So let's put it like this, background, bullish. I mean, we are coming to the chart with already multiple points of data. So those multiple points of data allows us to think thoroughly about the bias, and we could establish that whatever the reaction we had, it only comes to about 1/2 of the rally that we have had, and there is some kind of support evidence, right, that the price reacts off that support of that 1/2. So the background looks to be bullish. What is the next most important observation that we could make? I'm sorry if I'm asking this question again. You will have to write it down again because there are a lot of answers that are coming in. Okay, so let's see. Automatic reaction, volume decreasing, volume decreasing. Okay, let's talk about the volume decrease. So I would say that yes, for sure, just generally the volume is decreasing. It could be just market related. So, but I'm going to give that to you. So, and I'm going to say volume is decreasing. So therefore, what is going on with the supply as the volume decreases? Let's right away, deal with that. Okay, so supply is decreasing. What is happening with the demand? Demand is decreasing as well. Yeah, the volume signature decreases. So we observe both decrease in the supply and demand. So we also could look not just at the volume itself, and for those of you who has taken this course before, you guys know what's coming next, right? So what kind of exercises we're going to have. We're going to look at the volume signature and we're going to construct the price signature just based on the volume without looking at the price. And this is going to be so daunting, and kind of like, how in the world could you possibly do this? Then I'm going to give you the price action and you're going to create the volume signature out of this. And you're going to complain again, how could I possibly do this? But once the exercise is done, you're going to see the logic behind it. So if you would not look at the volume and you would look only at the, let's say, reactions that are unfolding since the highest high right here, what could you say about the reactions and the spread on those reactions relative to the availability of the supply? Is supply diminishing more than the demand or less? So for instance, I'm looking at reaction number 1, reaction number 2, reaction number 3. What do we see as a character of the supply? Volatility is decreasing. Correct. Okay, and then within the construct of this 1, 2, and 3 reactions and looking at the rallies in between them. So rally number 1, rally number 2. Would you say that the demand is more active when the rallies happen? You know, that it produces a better result than the reactions? Yes. So supply is diminishing. Demand is doing the same, but result is better. Okay, next. What's the next observation? Why don't we just kind of like finish our initial thought on the rally itself and then the reaction? We said that the reaction is 1/2 of the rally. Okay, and I want to also talk about the character a little bit because this is going to be important. What do you see the character of the rallies to be, especially at the beginning of the chart? We see a lot of what? At the beginning of the chart. What do you see in the price action? A lot of, okay, I like that, verticality. What does verticality usually mean? Momentum, right? A lot of volatility to the upside, ease of movement on the relatively high volume signature. So whatever effort comes in, the price follows, right? So I like that, Philip, as well. Urgency. There is an urgency to, you know, to be in this position, to really quickly come into this position and, you know, to hold on to that. What about distributional characteristics that we see here? Why are they in the, you know, showing distributional upslope in trading range and not, let's say, you know, downslope in trading range? What does it mean? Francis saying profit taking leadership. That was the key. Yes. So we're seeing some kind of leadership characteristics in the rally that is happening. And we're concluding that not just from the momentum that is taking place on the rally, but also in the way and the shape and the character with which the distribution with the higher highs and higher lows unfolds. And also there is quite a lot of things here that we could see, like for instance, you know, all of these breakout bars, their behaviors, you know, would be suggestive that there is still some buying even at the higher level. So even though somebody is selling into that strength, somebody is still buying, which is inherently bullish character. So momentum increase, urgency, upslope in distribution. And then on the way down, we've talked about the character of the reactions, right? So that very, very submissive show up of the supply on the last reaction. Whatever selling has come, what could this tell us? Well, let's put point number 6, flashcard point number 6. What about the timing, just based on the way how the spread looks on the reaction number 3? Could we say that the timing is now just because selling has been exhausted to the point where we're seeing that there is not just a progress, there is no progress to the downsides, it's a high or low. The character of the selling is just so subdued. It's just so much different than on the reaction number 1 and 2. Could we say that this is the timing? Timing for what? there is a range of its own here. Let me take another color. Here it is. It's this downsloping range. You could also think that this is a formation, this was a sign of strength, and then this is just a low LPS. But the timing is probably suggestive that the move is going to happen now because selling has been exhausted to the point where the rally is going to happen. Okay, so here's your 6 major observations as flashcards. What kind of deduction could we make out of those? Reaccumulation, Sunit is saying. Okay, again, let me take another color. Okay, what else? Time to scale in, so point of entry from Rob. Bullish from Mike. Good bullish rally will occur. So Iqbal is talking about the character. So good rally. And what does it mean even, Iqbal, good rally? I mean, like, it's always a question like, okay, well, and we'll talk about this in a second. So let's just finish that. First pro buy, sprint pretty soon. Next rally will have good momentum velocity. Okay, so that's into so momentum increase, velocity increase. Okay. Lena is saying time to do a PNF. Lena, what about this? Could we conclude that we might have a significant move out of this formation? So, I always want you to think, deeper in the sense of how you could make that observation. Like if you have the volume signature, you could guess what the price is doing. If you have the price, you can guess what the volume is doing. If you have this as your cause, what kind of effect we're going to have there, right? Expected action in a healthy, normal, bullish environment. So that is a confirmation. Need to see a reaction at the top of the channel because on this time frame, bias is bullish, time is right now to enter, character maybe strong rally above the previous resistance from front. Yeah, so here's that resistance, and we're saying that if we're going to have a rally, we're going to overcome that. So above resistance. Okay, let me see what else. Okay, and I think that's enough. So look at that. We've made 6 major effective observations about what we see in this picture. And obviously we know how to do that. And we need to obviously to know how. We need to develop the skill how to observe those, because if I'm going to teach you in WTC1 what to observe, you might not still make the correct observation about what might come next. So, and then not all observations you might actually notice. You need to practice observing the chart in the correct way and thinking about what is it that I need to observe here. What are the main points of observation that needs to be made? And then after that, based on those observations, based on the 6 major observations, and we could have had maybe like even like 30, 50, 100 observations, 1,000 observations, but it would not do us any good, because then we would be stuck in our analysis. We need to be still quick about our analysis, but we need to be precise. We need to be effective. And then we need to think about what do we deduce out of our observations. Okay, so we're thinking this is a potential reaccumulation. The timing is probably now. The bias is bullish. We're probably going to have a good rally out of this just based on the exhaustion of the supply, where we're going to potentially overcome the high, the previous high, where we're going to see some kind of acceleration of the momentum. I would doubt that momentum would be the same as at the beginning of the chart. It's probably going to be less, because some of the buyers that we've had at the beginning of the chart, they already bought in. So they might be just holding on to this position. They might not be buying, or if they're adding, they might not be adding the same size. So I doubt that momentum is going to be the same as at the beginning of the chart, but momentum is going to be increasing relative to the rallies that we've had in the reactionary mode. Velocity will increase at some points. So let's see what happens next. This is the chart of Nasdaq 100, 1 minute chart. So I'm showing you the structure for the whole day from 6:30 Pacific time to the 1300 hours, the close of the market. And this was today. And I'm also showing you the point of the observation. The point of the observation was a trade that I made today. That was a simulated trade. Unfortunately, all of my trading accounts are at the 100 capacity. I'm 100% invested. So this was a simulated trade. And again, somebody's going to ask me, why do you do this? You're so busy. Why do you even care about simulating the trades, at this level? Well, because I want to remain on this level, and if I want to remain on this level and be even better, I have to practice each day. Market gives me an opportunity to practice each day, so why wouldn't I do this? Why wouldn't I take this? If I would have, it's just right now the climate is such that I kind of see an opportunity to be over 80% invested in your portfolio. So therefore, that's just the situation. So here is this trade. Please tell me, why was there an exit here? Let's start with that. Let's talk about the trade, and then we'll talk about the characteristics of the rally. Why do you think the exit was here? Change of character, change of behavior bar. Yes, absolutely. So we see kind of like these two bars that are doing a couple of things there. They are breaking the trend, so there is a break of the trend. There is supply emerging in that particular instance, and then the downward result is increasing. So we kind of seeing how effort is increasing, and that changes the structure. What else? What comes prior to that? What about this environment right here? So remember that a break of the trend is going to be more of a structural thing, whereas this is more of the condition that is being presented to us before the structure collapses, right? Okay, so I'm seeing slowing of the momentum, that's correct. Shortening of the thrust, that's correct. Overbought condition, that's correct. And if we would be, thinking about constructing some kind of trend line channel here, we probably would be saying that there is some kind of overthrow here into the climactic action. And some of you are saying climactic. Specifically here, if we would look at the structure, we are seeing the exhaustion into the climax after the breakout bars. And these are the most important bars that we see here, on the way up. So if we would go through these bars and we would make some kind of determination as to the strength of the uptrend, what could we say about those? Well, first commitment to the upside. Let me take another color. First commitment to the upside above the last commitment to the downside is decisive. So we're thinking that the timing is correct, although I'm notoriously early into my trades. You guys, who have known me for some time, you know this, especially Franz, right? So Franz, this is going to go into the anatomy of the trade, and again, that phase B entry for me is just like my nemesis. And I've been thinking a lot about this. Again, my only assumption here on the early entry, and somebody might say like, are you kidding me? Like you just off by maybe like what, 10 minutes or so. But you know, the key for me personally, and this is where I'm pushing you guys as well, is a thought about the most efficient trade and the most optimized points of entry and the most optimized point of exit. And if we are going to take that as our goal to reach, and every trade is going to be conducted with that mindset, that, and I know a lot of people don't like the word perfect. I actually love this word because I'm always striving to be closer to the perfection as possible, because that would mean that not only my profits are going to be better, based on my timing, but also my risk profile is going to be better. Think about that. And like, if you're opening the position at the correct timing, the position should become profitable almost instantly. And that would not jeopardize your emotional state of getting out of the position. And then, the exit is obviously also has a lot of optimization, techniques that we need to think about, because the most optimal exit was most likely either on this bar or on this bar right here. Everything else is kind of like suboptimal at this point. But first, we need to learn how to conduct profitable trading. And then at the more advanced level, you will be asking yourself, or I will be asking you questions about how do you actually optimize your trades, and what needs to happen. So never mind. Let's come back to our analysis of those most significant bars that we're seeing, on the way up. This is a great breakout. It shows strength of the trend. This is a great breakout, shows the strength of the trend. This is a great breakout, suggests continuation. This bar starts to exhaust itself, right? So the spread, the up spread, starts to show deterioration. And that happens in the context of overcoming this resistance here. So what does it tell us? That the price is stopping, and we could see some kind of changes coming on where we're going to see the conditions develop for a potential reaction, which would be a change of behavior. And then on the background of what? Of the increase in volume signature into the best bar of the trend, and then decreasing volume signature that comes next after that. So we already know at this bar that this is our scale out opportunity number one. Next bar, the breakout bar, is not that aggressive that we've seen, let's say, here or even here. It does break out, but not that decisively. So we know we are in the vicinity. Also, we had the duration of the reactions here, and here, kind of showing us that we are in this kind of like free rise where there is an ease of movement, and it doesn't take reactions to form for a long time like we had here. This reaction is a functionality of structural position of where a reaction happens relative to where support was found. These reactions on the way up is the functionality of overcoming that supply that came, on this whole move down, and now supply has been absorbed and the price moves freely. But now look at the duration increase of this reaction. That is suggestive that either demand is getting exhausted, or supply is finally there, and we could see elements of the supply coming in, obviously, in the volume signature itself. So if I would be a little bit more precise, obviously, and would be paying more attention to trading rather than sitting in the meetings, and talking about the business and the classes, or preparing or doing something else, maybe I would be a little bit more optimal in this trading. But it is what it is. I mean, like, we have to take what we do at at what it is at the face value, and then try to analyze and maybe say, okay, most likely this was the better bar to enter. This was the second best bar to enter. These were a couple of opportunities, to add to the position. This was the first scale out, second scale out, and then the third exit, and this was the fourth exit, something like that. And then for a swing trader, a campaign trader, you obviously switch to a longer time frame here, but that was not the purpose because this was just an intraday trade. Okay, coming back to our discussion about how the rally is going to unfold. So we are determining three factors that we need to know, right? So the bias, the timing, and the character. And if the first two are kind of very easy to understand, and usually students do not have any problems with this, right? The bias is very understandable. I need to know the directionality of the trade or the price coming out of the formation. I also, very easily understand the timing. I need, I would rather have the timing than the price itself if I would be given a choice of what to know, right? Would you rather know the price at which to come in, or would you rather know the timing? To me personally, timing would be the best. I would rather know the minute when I need to be there present and where I could come in, rather than the actual price, because the price could reside at the specific level on so many occasions. But the character is somewhat elusive. The character is something that the advanced traders would think about it. And you kind of have to get to that level. I hate to say this, and I'm pretty brutal with you guys because, whoever's going to be in this class, whoever's going to stay and decide, to take either WTC 1 or 2, this is the brutality that you're going to hear from me. Character is important. And if you don't see the value of it, you just not at the level that I want you to be at, and I'm going to push you there. You need to understand the character with which the price is going to move for different reasons. You need to understand whether we're going to overcome specific levels of the resistance. We need to understand what kind of reactions we're going to have. Would they potentially give us an opportunity to add to the position with the specific risk parameters, specific risk characteristics? How aggressive we could be with this position, how aggressively we could add to that position, and so on and so forth. So there are quite a few things to think about. Also, on the way out, because of the character of the trend, how would we be getting out? Is it going to be an upslope information on the distribution, or how would the momentum behave? How would the loss of momentum would happen, and so on and so forth? What kind of volume characteristics we're going to have, and what kind of volume is going to move and damage the structure for us? So it's important. It's important if you are developing, a high level of execution in your trading. So therefore, extremely, extremely important, to think about that. A couple of questions. How do you think so fast while trading a 1-minute chart? Well, first of all, and this is again, right away, I kind of like sense where you are with that question, right? So does it really matter whether we're looking at 1 minute or 5 minutes or an hour? I mean, to a certain degree, it does, and especially if we want to like time it a little bit better, right? But it doesn't really matter. You just want to understand the structure. So I could have put a 5-minute chart here, but I usually kind of want to see more details, and I think that maybe it just obviously that practice experience, years of kind of like trading, you want to at the higher level you will have the capacity to observe more data points and to observe them faster, more effectively, and then make more correct deductions about what's going to happen next, at least for the short duration of the time, and make those deductions much quicker. So maybe that's kind of like what is happening there. But it doesn't really matter whether, again, it's 1 minute or 3 minutes or 5 minutes and so on and so forth. It's just kind of like a preference here to see a little bit more details. Another question. What kind of trade is this? Day trading or swing trading? Yeah, so this was the intention for this trade, obviously, was an intraday trade. There was nothing, to that. There was no idea about, a switch to a higher time frame. This is something that we'll talk about during the course when we will discuss the trade management, the tactics. Okay, let's go to the next section. Oh boy, we are at 5:11. Mm-hmm. Shall we? Okay, yeah, really quickly. So just want to profile some of the trades. So really quickly, a campaign trade that I'm doing right now in my institutional account. This is silver, so I can talk about this right now because the entries were way, there in May and June. So there were some add-ons in the recent reaccumulation. But the more important is just something that we haven't talked about, because what is the methodology? What is Wyckoff method per se? Well, first of all, it's the collection of the beliefs. Collection of the beliefs about how the price structure could unfold based on the behavior of institutional participants or just participants in general. So we know that one of our beliefs is going to be that on a very basic level, that we have to have a consolidation as a cause in order for the trend to take place. And the second belief would be during this consolidation, we could figure out, based on the characteristics of the price and volume behavior, what institutions are doing. Are they buying or are they selling? We also have the belief in the Wyckoff methodology and just in general technical analysis that the smart money, they are the ones who are influencing the structure and they are influencing the trends themselves. So therefore, we want to identify their presence and identify their intentions as the intention for the bias and intention for the timing of this trade. So the next belief is going to be the larger the cause, the larger the effect, the larger the consolidation, the larger the trend. And we could see that silver has been in the consolidation for some time. Now, I could make an argument that the most important accumulation of institutional quality has happened only in 2019 and 2020. It did not happen prior. There was an attempt to take the price out of the consolidation, but it failed. The next attempt was much better because it had a much better volume signature. So more institutions were present before COVID-19 decline in this asset. And as the source of funding reaction into the COVID low occurred, a lot of those institutions still stayed in the position as they accumulated it on this rally. So think about the absorption of the supply that is going on through this trading range, right? So we are absorbing the supply on the way up, and then some of them are holding that supply and they're not selling, they're not reacting to this reaction. And then some of them are buying on the way down. So we have absorption number one, absorption number two, and then on the way up, there is a very aggressive vertical absorption that happens. Why? Because, well, first of all, we see this from the volume signature, absorption number three, but also just purely on the technical systematic level, what do they see? What do those institutions see? They are seeing rising prices that are actively rising up, so they are feeling the strength of their peers buying behind this rise of the price, And obviously, in their models and their systems, the systems are screaming it's a buy, so you gotta be in. And because majority of the institutions are driven by the performance matrix, they have to be in this position, and they are buying on the way up because they're just afraid that they're going to miss this opportunity. And that's how institutions think, and that's how institutions buy into this. And because of this buying and the increase of the participation, momentum starts to increase. And then with that momentum, a couple of things happening. First of all, we are starting to outperform other, asset peers like gold. This is a relative strength of silver against gold. That's number one. So one asset is more favored than another one. And with that, we have the price action that actually is starting to show much more bullish behavior than we've seen throughout the whole trading range. It's an ability to overcome the resistance and also an ability to actually stay there above. And then characteristically here specifically, we're seeing that the reaction itself is just so limited to the advancement. And that suggested to us that whatever backing up action we're having is of reaccumulation qualities, and then we potentially could have a consolidation. And I did talk about the analog from 2010, and that kind of like is my expectation. So that's trade number one. Trade number two, and this is what I've been showing also, to WTC1 students yesterday. I said that you gotta be vulnerable in this business and to be able to show your mistakes, not just to yourself, but to your peers. I'm not saying like, okay, and go and do this like myself, create a position that's going to be a mistake and then discuss it with friends in the anatomy of the trade and post it on YouTube and Twitter. That's a twisted mentality, but it's twisted only because I'm a teacher, so I have to do that. But it's also not just because I'm the teacher, because I'm a trader, and because I'm the trader who strives to improve with each of the trades, and I fail. And that failure is an opportunity for me to understand what am I doing wrong, an opportunity for me to find the solution to correct my behaviors, my analysis, my execution. And hopefully that is landing on you guys in this class, and it's landing correctly in your minds. That's why I'm doing this. This is an actual trade. This was done, in a hedge fund. You might be thinking like, wow, the hedge fund money is obviously different there. I mean, it's in the millions. And, it's hard to even kind of like think about those type of mistakes that could, be that much in terms of the monetary reward or monetary loss. But trading is trading. It doesn't really matter, the level of the money that you have. What does matter is what do you have as a system, as the as a trading plan, as your process, as your trade execution. That's what's so important. And I'm actually, okay with this trade. Why? Well, as I'm looking at what has happened prior to the point of entry, I don't see anything that I would do differently at this point of time. A COVID reaction shows a spring situation with the outperformance in that moment. I mean, one of the better things would be, to open position a little bit earlier, but that was just the administrative functionalities of the hedge fund at that moment. I couldn't do that. But then when they were originated, those positions were opened correctly. So, I'm talking always about systematic mistakes and, executional mistakes based on your own behaviors. The system behaved okay, execution was okay as well, and then you are going to have this uncertainty that's going to happen in the marketplace, and you're going to have trades like this, and you might argue, okay, well, I see the supply here, this reactions a little bit more. But in the context of this whole analysis and the structure, it might not happen, it might happen. And it did happen. So what are you going to do about this? You have to make that decision. What caused the drop? Yeah, that was, some earnings announcements. And instead of kind of like parking the money and inefficiently going through this stop in action with a kind of like idea of where we're going to stop and then how long of the duration of this reaction we're going to have, uh, my choice and my partner's choice was just to get out out of this trade, even though you already could see some of the bullish characteristics as the price goes down. But the current market in 2020 was so fast, so dramatic, that even a month would make a difference. You could invest or reinvest this money into something else, and it would be a much better decision. So again, there are so many layers of thinking, and usually I think that people underthink trading. They're not really overthinking this enough, especially at the beginners and intermediate level. I think at the advanced level, you have to underthink because you know too much. But in terms of the first initial levels, you have to overthink, what's going on. All right, next time frame. This was, most recent swing trade. So this one was actually okay. This is Roku. This was one of the better trades that I had in the last quarter in my personal account, together with Tesla. Those were like the two good trades, and then just a bunch of kind of like average trades that still brought some profitability, but not as much. This was interesting because I was calling for Roku, to go up right here. And that was kind of like a campaign call that was missed. And nothing has changed since that point. We're going into another consolidation that has not, a big height in the formation, that has some minor sign of strength in the middle of the structure. The major sign of strength happens on the really great breakout bar. So I couldn't just wait. So in my personal accounts, I kind of like, started loading up. The next formation also does not have that big height. And it just was beautiful the way how it was unfolding. And I had some misbehaviors in this trade. I will have to come back, and maybe it was Franz will, in the anatomy of the trade, will analyze this a little bit better. I think one of my exits was around here, and then I was just realizing, and I was kind of like analoging it to this scenario right here, where the price overcomes the medium and then stops, and then goes into the consolidation. So that was kind of like exit based on that. And then around this time, I was agonizing, and I was thinking, this is not how it's going to unfold. And I better be back into this position. So I actually added, to the scaled out size that I had. I had to come back to the original size and just continue with the movement up, and then just the exit into the touch of the climactic action. I think emotionally I was a little bit compromised with all of those ins and outs. It didn't feel like a clean trade to me. So I said that this is my kind of like minimal target zone, and I want to get out, and I did. So that was the swing trade. And again, the reason why I'm showing you all of this, I want to show you that the principles that we discuss in the Wyckoff methodology work on in different time frames. And usually, a method or methodology or a system should be applicable in different time frames and with different assets. So whenever somebody comes and people ask, well, what about cryptos? What about futures? What about let's say options or anything else? It works there. This was an options trade that I've conducted on a stock, and I used the swing time frame here, to conduct this trade. Let's go to another one. Well, I've shown you, a simulated trade today in Nasdaq. This was an actual trade on December 15th. The principles are kind of the same, right? So you're looking for that main observations, and the main observations at that time were that the daily uptrend was still up. We had a quite substantial move down. The volume increase suggested the presence of the demand. We stood testing points. Thank God I didn't enter in phase B, even though I know that I would hold on to this as the stop loss was here, so that wouldn't be a problem. The problem for me is just to intellectualize my misbehaviors on the entry, and I do that, and I'm being extremely tough on myself, as I should be. You know, if you are in this profession, you should be tough on yourself. There is no reason to be light on yourself, you know, with the mistakes that you make. Otherwise, you are not going to progress. And nobody can convince me otherwise, because I'm going through the same type of, you know, growth as a trader myself. So the actual entry here on the actual trade was, you know, much better than today. And then just different lines, you know, of where I would be expecting the price to stop. So this was a point of exit number one. This was in the vicinity in the target zone. That's number one. That was climactic. There was no thinking there. I just kind of exited at the close, anticipating that we're going to have some kind of trading range. And then the remaining size was an attempt to see a continuation. I think the biggest mistake here was, you know, not recognizing, or poor recognition, that you still have a lot of time into the end of the session, and your bias off the low is still up, and whatever attempts, you know, to go up that failed, they could be temporary, and that's exactly what happened. But I remember that particular day, and you know, mistakes you remember, right? Because they kind of make a footprint in your mind that is significant, and you keep thinking about this. At least that's how it happens for me. And you know, I I was thinking a lot about this trade and other trades as well, especially where mistakes have been made. Um, this was obviously, you know, a wrongful move right there. And you know, I just was in the meeting, and as I meet people online, on the background, I'm trading. So if somebody talks to me during the trading hours, sometimes I would say, like, you know, hold on a second, I'm in a trade. I need to think, just, you know, well, at the inflection point, what's going to happen, and so on and so forth. Um, and one might say, like, why do you even do that, right? Why do you even trade like this when you meet with other people? Well, because that's the actuality of my life. This is my lifestyle. So I need to figure out the way, or how to be efficient with the trading that I want to do, and not to jeopardize either my trading or my meetings, because both are important. So I have little sympathy for somebody who's going to come in and just say, like, okay, well, you know, it doesn't happen to me because my routine is off. Well, figure it out. Figure out your routine so that you would do things like this. And you know, even with this trade, which I would probably give myself, maybe, I don't know, um, and Franz would be laughing at me here, because he always kind of like overestimates in my thinking, you know, the results that I have, and I always underestimate them. And I think underestimation of my results actually lead me to this progression, you know, to be better, you know, to chase that perfect trade, something that I and William, you know, talked about a lot privately. You know, we are in acceptance that the perfect trade exists. Where was that perfect trade? It was right here. This was the perfect exit. Everything else was suboptimal going into the end of the session as we're consolidating. It was more optimal, you know, going into the swing trade at the end of the session, thinking that the bias was still to the upside. Ironically, William made the same trade, and he made the correct decision. His exit was here as mine, and then his exit was here, as it should be. So kudos to him. Um, well, anyway, so different trades, different time frames, different instruments, doesn't really matter. You know, what we trade, what time frame we trade. Even doesn't matter what methodology we trade. I mean, specifically here we're discussing Wyckoff method, but you could take any methodology. A good method will always have the basics, or rather the basic beliefs that are correct representation of what the market is about. It will not predict all of the ups and downs. It will not predict all of the tops and bottoms, but it will get you into the trending environment, or it will allow you to extract the money in the consolidations, based on the oscillation of the trades. And the good methodology will have a systematic approach as to how we view the conditions forming for a potential reversal, for a potential continuation, for a potential confirmation. And also a good system will allow you to create a trading plan, which you will have to individualize just based on who you are. But that trading plan is going to be all rule-based. And that methodology will demand from you to test this trading plan for the validity of the execution of this plan in different market environments, whether it's a trending environment, down, up, or consolidating environment. And that's exactly what we're doing just generally with Wyckoff Analytics, because we've created the whole path for you, from knowledge to skill to process, to self kind of like realization and exploration as a trader. And hopefully you guys kind of see that. All right. Well, we're going to stop here, but before we do, let's definitely look at some questions. Okay. John is saying, good thing is that you don't have to be perfect in trading to pull consistent money out of the market if you have good risk management. Absolutely. This is a profitable trade right here. Even though I'm saying it's not perfect, but it's profitable. You're still making money on this, and especially depending on your size. I mean, this trade could pay off for the whole day of work, and it's just one trade. There is nothing else. Okay, what else? Do you think trailing a stop loss in this intraday is a good wait for the last exit? Absolutely, Gaurav, and I think this is a really good point. And actually, I did have the stop loss, I mean, like actual hard stop loss, just below this bar. So just moved it. Why? Because first attempt to go out, and then the second attempt, and I moved the stop loss right here, and that's how it got me out. Another question. Do you agree that trading is all about probabilities and expectations, even though hard to quantify exact probabilities? Well, it definitely should be about probabilities and kind of like expectations based on the probabilities as to what might happen in the short term and the long term scenarios. That's for sure. But you could kind of like hide that type of thinking and don't necessarily advertise this, that you're thinking in terms of the probabilities, and still think in terms of probabilities. What do I mean by that is that, if you're seeing a specific pattern where you have, all signs of their accumulation, the probability is on your side that we're going to have a rally, and then you could, argue about the character of this rally, where it's going to go, how it's going to go, what kind of reactions we're going to have, and so on and so forth. But you don't have to necessarily think every time that, oh my gosh, what is the probability here? Is it 50%? Is it 80%? And build expectations on that. But, at the core stone of our thinking and beliefs, yes, probabilities is definitely going to be something that is going to be ingrained in us. And we obviously is going to be always thinking that even though the probability is very high that this trade is going to materialize in our, you know, favor directionally, there is a smaller probability that it could still play out. Even a 1% probability that from this accumulation area, the price could fail, something happens, like the news happen, and it just collapses on us, like that Sienna trade, like that Biomarian trade that I showed yesterday to WTC1 students, that might happen. And thinking in terms of probabilities that way, that 1%er could actually unfold, is a very healthy thing in trading. So I encourage you to think this way. Franz is saying, okay, it's good to be critical of your decisions, but never of your self-worth. I think Franz and I kind of like, go back and forth and we have this conversation. Yeah, for sure. I mean, like, this is a big distinction. This is not the conversation for today, obviously. But, whenever I'm critical of myself, I'm should specify I'm not critical of myself as a persona, as an identity, right, as a self. I'm critical of my execution, and critical again is kind of like always perceived more as a negative word. Maybe because I'm not an English speaker, I perceive words differently, so words have slightly different meaning, and therefore being critical means that there is some kind of opportunity to explore the improvements that could be made. Okay. Okay, great. Jordan, thank you. Among the models of the Dow, Elliott, Gann, Merrill, and Wyckoff, which one performs the best? Are there any other methods? So I started, for chartered market technician exams 1 and 2, did not take the third exam, which I kind of regret. I should have. And obviously, that examination allows you to go and explore and research and study a lot of different methodologies. So just on that basis, I did study the Dow, obviously Elliott, a little bit of Gann, not necessarily Merrill, and Wyckoff obviously is the method that I used, the most. So I think it's a personal preference, and I think that once you are at the advanced level, you kind of understand that it is a personal preference, because something in the way how the method or particular method explains to you uh, how the market functions, what are the main beliefs about the market, and how do we exploit that. And by the main beliefs and how we're exploiting them, we're just basically saying that we are exploiting the understanding of the human herd mentality, and how um, how people behave in the marketplace and in life in general. Because I always say trading is a mirror of self. And you could look at the herd mentality in the markets, and you could say that trading, as a herd mentality, is kind of like a mirror into the society of who we are, how we behave as people in general, as a herd. So I think it's very individual. I really liked Elliott Wave because it also discusses a lot of structural uh, things, right? How would the price unfold? How would consolidation happen? What are the possible scenarios? What are the possible scenarios of the advancement of the decline? So structure always appealed to me, because I think there is some systematization of the way for thinking about what's going to unfold in the environment that is uncertain. I studied Gann on my own, and I just failed. I just failed to understand it to the degree where it would be practical. There were some points that I really liked, and there were some successes that I had, and I think that would I allow myself to be a little bit more open-minded, I probably would, succeed with that as well, to a certain degree. Maybe not as much with with the Wyckoff methodology. Uh, but Wyckoff methodology, I think, has this kind of like quality that allows me personally and other Wyckoffian students to understand what is going on in the market and also have the structure to go about this. And in a lot of cases, people are saying, this is what I didn't like what Hank was saying, and by Hank, I mean Hank Pruden, that it's a discretionary method. To me, it's absolutely a not discretionary methodology. There is really nothing discretionary in the way how you observe the data and what deductions you should be making. The whole idea about the discretion is so far-fetched in the trading world. The best traders are not discretionary traders. They are systematic traders that installed their beliefs and their rules into themselves to such a point, and they repeated, those trades so many times that it feels like it's a discretionary system, but it's not. In their minds, they're just not registering it, but there is a process. There is like step 1, step 2, step 3. I'm looking at different scenarios, and this happens, then, I'm going to act this way, and so on and so forth. So, methodologies, the way how we function in the marketplace should never be discretionary, up to the point when you are at such an advanced level where systematic approach is just a part of you, and then you are quote unquote discretionary trading. All right, what else? Okay, I think that's it. All right, guys. So for those of you who are students in this class, so don't forget about the homework. This is where we're gonna start, our next class next Tuesday. So you have 2 articles to read. You have a bias game to do, and you have to think about the stock, to trade for us for the whole semester. And then also for those of you who would like to do this, the homework number 14 from the previous class, that's going to be, an important thing for us to do and to go through. What else? Am I forgetting anything? For those of you who are thinking of signing up and you say that, oh my gosh, this is a great class, I want to sign up. The first question that you should ask yourself is, have you taken WTC1 class? Because if you have not, there is no way I'm going to get you into this class. It's just too much. You're going to be a big distraction for all of us. And even though you might say like, oh, I understood everything, I bet you 100% that not everything was understood. You're just kind of like understanding that, you understood maybe the majority of it, but there are some nuances that, should come about where you should say like, I didn't know that. I didn't think about that. That didn't come to my mind. So you really, really have to go in a specific sequence. And then if you are having any questions about either of the classes, contact us at Wyckoff Associates at gmail.com. Either Nancy or I will reply to any of the questions. And, hopefully you guys like the material, like, what we do, kind of like I was trying to show you exactly what we're doing in the classroom environment, what kind of teaching, I'm conducting, what kind of beliefs I have about the markets, about the students, about the ways of how we practice in this. And right away, I'm establishing the intent to get the students that I want, that, the students that, even as observers, they would be active thinkers about this material. They would be active thinkers about what they do in the marketplace. So if you're one of them, I definitely want you in this class. All right, guys, with that, thank you so much. And I'll see you next week. Thank you and bye-bye.